Hi everyone, my name is Prayan Fernando and I've got here with me Don Brown.
Hi everyone.
And given that we're already into June, we're getting closer to the end of the financial year, it's the best time to talk about tax. And who better to talk about tax than Don Brown?
Thanks.
So Don, people stress out when they get to June talking about tax times, etc. That's usual, that's common?
It is. Particularly it gets a lot of media attention, who the tax office are targeting, what you've got to be looking out for when it comes to preparing your tax return. So there's many things, and yes, people do start to, their ears start to prick up and they start to look at their tax and then look for tips and tricks about planning for that end of year.
Excellent. So we're going to talk about tax time tips. Right. Let's start off with probably talking about income. Let's keep it as exciting as we can, Don. Right. Let's start talking about income. So, what should people be wary of when it comes to income?
So with income, and I've broken it down. There's three main topics here in the slide. The first one is timing. So looking at, have you actually earned the income in that particular financial year, or was it actually, did you receive a payment in advance from clients or customers that you can potentially push to the next financial year? So it's checking your customer contracts. You may have received deposits from customers that you aren't actually delivering on until next financial year. So timing is one area that you should look at with respect to income and whether you can move it to a future year. The other one is whether it's determining the nature of the income, whether it's ordinary income from your normal trading activities or whether it's in fact capital income. And what I mean by that is it treated under the capital gains regime. So, and just to give you a very brief example, ordinary income, as I've mentioned, is your trading income from your ordinary business activity. But potentially if you've got a business that has assets or investment, particularly investment assets, and you sell those, then that's a capital gain event, and that's referred to as capital income. It could take you into a different taxing regime as far as concessions are concerned. So ordinary versus capital. And the third one is about non-trading income from investments. So just ensuring that at the end of the year, you've got all your trading income from your business activities, but if your business or your company or yourself has other investments out there, is to capture that income that you've earned from those investments.
Good one, Don. Good one. I think the timing is a critical one, isn't it? Especially when you're in business, there are people who pay deposits in advance. Yep. You don't want to recognize that as revenue if the delivery of it hasn't been done.
That's right, Priya. And we've got a good example in a client that we work very closely with, a manufacturing client. They manufacture equipment that they receive customer deposits, but often that equipment isn't due for delivery or completion until a future period. Correct. So yes, we work a good example on that one.
Yep, nice. Let's move on to expenses. What do business owners have to be wary of when it comes to expenses, Don?
Just a couple of tips. Again, similar to with income, it's again timing. So just trying to book all your, particularly if you're working on an accruals basis, booking all your supplier invoices into your accounts so that you're recognizing them as an expense. What you also have to be mindful of is if that expense, again, very similar to income, if it's a prepayment of an expense, there are certain tax rules around claiming a deduction for prepayments. In other words, paying the expense now, but it isn't actually going to be incurred until a future date. So there's some rules around that. But just the main thing here is capturing all your expenses in the year as you possibly can. And then I've mentioned here also looking at superannuation. If you've got staff, it's if you can pay the superannuation up to 30th of June before the 30th of June ticks over, you do get a deduction for that. If you carry forward an accrual for superannuation, you can't claim a tax deduction until superannuation is actually paid. So just looking at that. Another tip is to review the asset register. Just making sure that the assets that you have on the balance sheet are in fact still usable, or you may be carrying assets that have got no value, you're not using them anymore. So essentially you can scrap them and then claim that scrapping amount as an adjustment in your depreciation schedule as a tax deduction. And then the third tip that I've mentioned here is stock obsolescence. So looking at your closing stock or your stocks on hand, particularly if you've got perishables or if you've got redundant sort of technology that's sitting in your stock that would have been used a number of years ago, you're still carrying it, is looking to make sure that you're realizing your correct closing stock value. And these are all methods that will help to reduce your ultimate taxable profit in the business.
Nice. Don, just for those non-accounting people out there, you mentioned a couple of terms there, accrual and cash basis. What does that actually mean?
Okay, so for small businesses, Priyan, you can elect to either prepare your tax return on an accruals basis or a cash basis. The difference between the two is this. If you're using an accruals basis, if you've raised an invoice to a customer for income during the year, you will recognize that as tax, as income for tax. Similarly, if you're bringing in supplier invoices as an accrual that you haven't yet paid, you will still pick those up as a tax deduction. That's the accruals basis, maybe a little bit simplified. If you're using a cash basis, it's only where you've physically paid that supplier as a deduction and where you've actually physically received the money from your client as income. So that's the difference.
Awesome. And you may have accrued expenses as well, which means the expenses that have been incurred in the current financial year, but you haven't made a payment or you haven't received an invoice yet, but it's important you bring those into your current financial year under a profit and loss statement, under the accruals method.
Exactly.
Correct.
Yes.
Yep. Awesome. All right, that's essentially the income statement or the profit and loss statement that we've covered. Let's move on to the balance sheet. What do we have to be wary of when it comes to the balance sheet, Don?
Okay, so with balance sheet, you'll see that that's where the assets or the business use assets are contained by the company. They're reported in the balance sheet. It's just making sure you're using the appropriate depreciation rates as prescribed by the ATO. You've got clients who, or you can actually self-assess the useful life of the asset. It really depends, and you've got to report that you've done so in the tax return. So one is just making sure you're using the appropriate depreciation rates and claiming the correct amount under the ATO prescribed rates. Looking at your loan accounts, and particularly where directors have drawn money or shareholders have drawn money from the company, they owe the company money, Division 7A loans, making sure that you're addressing those in that one, you've either met the minimum repayments, or two, the company has appropriately recognised the amount of interest those Division 7A loans attract. And the other one is looking at your prepayments that you've booked from the prior year that you can then reverse into this current year. So payments that you've made in advance that you haven't essentially claimed a deduction for last year, still sitting in your balance sheet, you need to remember to pick them up as a deduction potentially in this current year.
Yeah, and insurance would be a good example.
Insurance is one, definitely, Priyan. And then looking at other items that are capitalised that you potentially could write those off over 5 years, recognising those, and particularly one example is legal expenses, another one is company formation costs. You book them to the balance sheet, but making sure that you are then amortising those appropriately over the 5-year term and bringing those into the profit and loss. From a liabilities perspective, looking at if you've got any chattel mortgages or loans for equipment, just ensuring that you're picking up the interest on those loan monies and bringing those into the profit and loss. And if you've got leasing, just making sure that your lease payments are appropriately accounted for from a tax perspective and expensed accordingly in the profit and loss statement. And finally, just checking off any potential tax effective dividend payments to owners. So looking for, and this is where tax planning is vital, looking at the individuals behind the company and whether it's a potential good year to stream some dividend income out to the owners in a particular tax year.
Awesome. Awesome. Thanks, Don. So that's on the balance sheet stuff. So we've covered the profit and loss. We've covered the balance sheet as well. Next up, we're covering PSIs versus PSBs. Do you want to explain to everyone out there what's PSIs and PSBs? So
Priyan, yes, PSI and PSBs. Interesting concepts here. PSI is personal services income, and PSB is personal services business. Right. I did believe this was a good point to mention, is that particularly when people incorporate their company, they then look to push all their income into that company and pay tax at the corporate rate. The tax office have introduced legislation, it was quite a while ago, in that if that person is actually an employee of a company or is acting similar to an employee, they will still be taxed at their personal marginal tax rate on that income. So it sort of removes the company from the equation, so to speak. And there's a number of tests that are used to determine whether the individual will be personally assessed on that income or whether it can still be assessed under the company structure. Some of those tests are you being paid to produce a specific result, and required to provide your own equipment or tools, and required to fix mistakes at your own expense? That would potentially qualify as income under the company and taxed under the company, even though it's performed by a particular individual. There's other sort of tests. The 80% rule, how much of your income in the company is from one particular client, and including their associates, or is it spread over a number of different clients? Looking at if there's less than 80% of your income, you would then move to the remaining tests: unrelated clients test, employment test, and business premises test. So unrelated client tests are clients that you've got your main client, then you've got unrelated clients that make up your client base. An employment test is simply ensuring that you control when you work, how you work. You're not directly supervised. And then business premises test is, have you got your own business premises? So when you look at it holistically, if you meet a lot of those tests, you will be considered trading as a company and then having your income assessed at the company level, in the company structure.
Oh, awesome, cool. So that means this is an important section for people out there who are running businesses, right? Because there's sometimes can be grey areas between what's personal, what's business expense, what's personal income, what's business income.
Yes.
So it's really important that we understand, or people understand this aspect.
It is particularly when people look to set up companies, they just need to consider, will they, and if they've only got one client and they're looking to try to sort of subvert that employee-employer relationship to take advantage of the corporate tax rate, they really need to consider these PSI rules before they make that next move.
Absolutely. Awesome, Don. We've covered the profit and loss, we've covered the balance sheet, we've covered the PSIs and the PSBs.
Yes.
What are some of the other considerations that we've got to be mindful of when it comes to tax time?
Yeah, and this is the final slide, just some capital gains and potential deferral on sale of assets. So looking at if you're particularly selling an asset, and this generally relates to property, the taxing point is the date of signing of the contract, the exchange date, not the settlement date. Okay. So if you have a choice between settling, or rather exchanging contracts on the 29th of June or the 1st of July, you would always choose the 1st of July to defer that ultimate tax on that gain. So just being mindful that it's the date of exchange or signing of the contract that creates the tax event in that particular year. The other one is GST registration requirements. So if your business turnover you believe will exceed $75,000 per annum, you must register for GST. We've had a couple of clients in the past that have believed they weren't going to meet that $75,000 per annum limit. Lo and behold, final quarter they've exceeded the $75,000. They should have registered for GST, then it leads to amendments of BASs, etc. So just being mindful of that. And then the other one is, and it's fringe benefits tax, or FBT. There's a number of clients out there that probably don't really know much about FBT, but it's things such as entertainment expenses. So those those business lunches, those client lunches, etc. Yes, they are business, and the tax office recognise that they're business, but they're also considered a fringe benefit to the employee of the company. And it might be your company. So you're a director, you're a shareholder, you're an employee, you wear a number of different hats. So just being mindful that entertainment expenses are captured under the FBT regime. And then with FBT, it's provisions of other benefits. So you may have bought a car in your company's name. It's a simple passenger vehicle. It's not a work vehicle. By very nature that you have access to that motor vehicle and you garage it at your home, the company is providing you a fringe benefit, and then you're creating fringe benefits tax issues for the company to address. So just being mindful around FBT and some of, particularly when you're buying potentially private use assets in a company that you will take use of, could create an FBT issue in the company.
Great. And some excellent tips there,
Thanks, Priyan.
Don. And especially when it comes to this time of the year, people are concerned about, what is tax deductible, what is not, what is under my personal tax return, what is under my business tax return.
Yes.
And tax can be a complex beast.
It certainly can, Priyan. And I've only just highlighted just a number of issues in our presentation today, but there's many more considerations. But and clients have lots of different scenarios, so it's really reaching out if you're unsure, so that you've got clarity on your way forward, particularly when you're tax planning.
Awesome. So if you out there need some help on the tax side, whether it's your personal, whether it's your business, etc., you can reach out to Don Brown. He's an expert in the area. How long have you been doing taxes, Don?
I'm showing my age now, Priyan, probably about 40 years.
There you go.
So a long time.
Yeah, a long time indeed. So the best way to get in touch with us is the email on your screen, info@businessmetrics.com.au, and that'll get the attention of Don Brown, and he'll get back to you soon. Thank you for having us today.
And look forward to helping you guys. Thanks, Priyan.
Cheers. Thank you. Now, if you resonated with this video, please like, share, and subscribe to our channel.